Okay, good morning, everyone. Welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we have a lot to cover with you this morning as things are opening up significantly higher than where we closed yesterday. So let's go ahead and look at where we currently stand. So before I get started, just a quick disclaimer. What we're going to discuss here today is purely for demonstration purposes. It is not a solicitation to buy or sell any specific securities. So let's start off by talking about where the current market stands. We spoke about 273 as a major resistance level that we broke out above last Friday. We continue to see that this Tuesday when we talked about it on Tuesday, and markets are opening up even higher. Now, I do want to talk a little bit about some of the adjustments that I wanted to make to some of these levels, because for the past few weeks, we've been talking about 273 as a major support, a major resistance level that we've been watching. We finally broke out above that last week. And the 273 level came from this particular low that was set after the initial rally that we have off of the December 2018 lows. But going back to the charts and looking at where price actually traded predominantly in 2019, what we're doing is we're adjusting a little bit regarding our resistance levels up to that 284 level. And one of the reasons that we wanted to adjust to the 284 level is because that's actually where price predominantly spent for the most of 2019, and a lot of the accumulation that happened between April and that November breakout that we had was between 284 and 302. So what you have is a lot of buyers who have accumulated stock in this particular area that, and also a lot of buyers who have accumulated after that subsequent rally that are looking to get back to break even and potentially sell some of their stocks. And that's really where we think the major resistance you're going to see is above this 284 into that 302 zone. So the fact that we've broken back above 284 certainly is bullish, but this is really where we start to see some major selling that we think will start to step in. We're starting to see a little bit of that, and today, we're breaking out above 284 to 286 right now on the open. So let's take a look at where markets are going to head today. So we have a lot to share with you to take a look at this. Now, first of all, markets are very much in what we would consider a very optimistic a glass half full type of view on everything. So we want to talk a little bit about what is the market currently looking at that substantiates this type of rally that we're currently seeing with respect to earnings and everything else in terms of the economic data that we're currently looking at. And then we want to take a look at some of the actual data to see, where do we line up with that and what opportunities do we see in the market from this. So first of all, we're seeing very strong inflows into high yield bonds. And this is partially because, as we announced on last Friday, that the Fed is now going to backstop not only investment grade, but also some of the junk bonds. So high yield bonds that were originally rated as investment grade, but knocked down to junk status as a result of the coronavirus. The Fed came in to backstop that market. So we've seen some very significant inflows back into high yield. That goes to stabilize the markets. That certainly brought a lot of the liquidity back into the markets. So that's been a strong driver of the rally that we've currently seen in this market. Now, you couple that with the fact that we've seen fairly significant improvements in COVID-19 trends from countries around the world, flattening the curve. Italy, Spain definitely passed the hump, but the road to recovery is still fairly long at this point. US data still is not particularly great, but it certainly seems to like we're past the peak and we're starting to talk about when can we open the economy. So the market is really forward looking at this point and no longer focusing on the fact that cases are still continuing to grow, that there's still a lot of damage. It's more focused on when we're going to reopen. There are a few states that have been talking about opening up very soon. So there's a lot of optimism around that. But I do want to point out that there are a few countries right now that are experiencing what we consider a second wave, something that we knew might happen, not necessarily definitely going to happen, but countries that reopen perhaps a little too early see a second wave of coronavirus cases. So we've started to see an uptick in Singapore and Japan. Now, Japan certainly locked down significantly later than most other countries, not until the first week in April. So we expect Japan to continue to see some further increases in cases, but Singapore certainly is one that started to open up their economy, but is starting to see a second wave. So those are some of the data points that we're currently looking at for that. Now, markets did, I think, rally fairly strongly last night after the close, after Gilead had some, what we would consider decent results or positive results on their HIV drug for battling coronavirus. Now, we're still looking at the data on that right now. It seems like that data is a little early. It's based on a fairly small case study, so I don't think it's the best idea to jump into that just yet. However, there are some positive gains from that. Now, some of the data that we've been looking at for the last few weeks is travel and credit card data. I want to share with you some of that data, both China and US travel data, as well as some credit card data. And lastly, I want to talk a little bit about some of the disconnect that we're currently seeing with the economic numbers that we're currently looking at with the market. So taking a look at, one other chart that I wanted to take a look at is emerging markets. So right now we've seen this strong rally in the S&P 500, fairly large cap names, and the concentration right now in the large cap names is at historical extremes. A lot of things right now are at historical extremes, but the concentration of the top 5 stocks in the S&P 500 now make up 22% of the entire market weight of the S&P 500. So you have 500 names, but 5 names make up 22% of it. We've never seen that extreme before. That may cause some issues going forward, but that might explain why the markets are rallying so strongly, is because of that high weight that we're currently seeing. But emerging markets, small caps, have been pretty much left out of this rally. So emerging markets have bounced barely 30% off the lows. Same thing with emerging markets. That really shows us that this rally is really concentrated here in the very, very large cap technology names. And the rest of Main Street, the rest of the world, is really being left behind in this. And that, I think, provides some of the opportunities that we see going forward. Now, this is the quote unquote second wave that we were concerned about. And this is not to say that we are going to experience a second wave, but this is just data to show that there have been countries that have opened up or kept their borders open, and they're now experiencing a stronger wave of coronavirus cases. Singapore and Japan are certainly two of the ones that we are tracking, but there are other countries that have already started to reopen up. Austria, Czech Republic. It's important to watch this data set to see and learn from that, because that's what we're going to need to decide when is the right time to reopen our economies. And I think in New York, we just extended it out to May 15th. I don't know if that's a realistic date. The original date of May 1st certainly was very optimistic. We knew that we were unlikely going to hit that date, so we moved it out to May 15th, and likely that might get moved out again once we approach the end of April and the beginning of May. So yet to see. There's still a lot of downside risks, in my opinion, here as far as when we reopen our economy. And I will say that there's a very large disparity between different cities. There are cities like Phoenix that have seen very, very low number of cases that may be able to reopen up very, very soon, versus New York, which has taken the brunt of all of this, is likely going to be a little longer. So, this is the data set that's very fluid that we're tracking right now to help us better understand is the true economic impact of all of this. Now, the travel data. Now, a lot of people have been asking us, is it time to buy the airlines? Is it time to start buying some hotel stocks, cruise lines? Those are some of the questions that you guys have predominantly been asking for the last few weeks. So I wanted to share with you some of the data. So China, we're starting to see improvements in the data out of China, and this is a good template for us to understand how US data will likely look. Chances are we will follow a similar type of graph here for the US. Now, the thing about the US data is that we are starting to slow down in terms of declines in travel, which is good, meaning stabilization is the first step towards improvement. So this is really where I think once this data is no longer declining, that's when we can start taking a look at some of these travel stocks. Over the last few weeks, I've said that I think it's too early. I think now it's time that we can start taking a look at some of these names. United Airlines reports today, Delta reports next week. Some of the names like Hilton and Marriott, those are ones that you might want to start taking a look at as especially as earnings are coming up, to see if those are ones that you can start, I would say perhaps selling some premium on to, because the premium on them are really high and you can use those as an alternative to buying the stocks. So those are the strategies that I would be currently taking a look at for travel stocks. The other data set that I want to share with you is credit card data. We've been looking at this data for quite a few weeks now, and now we have the update of the data all the way through April 10th. Now this is Bank of America credit card data, and as we've seen over the last few weeks, it's pretty, I would say, I don't think it's shocking to anyone to see at the top of the list, you have airlines, lodging, entertainment, restaurants, and transit that have seen the largest declines. And as you can see, airline and lodging still we have not seen any improvements. They're still under negative 100%, meaning that there's no improvement, that they're actually still refunding tickets right now. So, but as you can see, that number has pretty much stabilized over the last few days. So again, this stabilization is the first sign for, deciding that it might be time to start getting into or start taking a look at some of these stocks. As far as whether it's time to start buying yet, I think it's a little too early, but I think now is the time for us to start taking a look at some of the numbers in this particular space. Some of the interesting, some of the other ones that I want to point out is that clothing still remains one of the weakest sectors within the retail space. So these, if you look at Macy's, Nordstrom's, these are ones that have taken huge hits this week. I expect that to continue. I expect the weakness in this particular segment to remain fairly weak. Furniture is seeing similar type trends, still down 30–40%. So if you think about stocks like Wayfair, those types of stocks are going to decline. Restoration Hardware, those are the names that you might want to see. You might see further declines in department stores, really very weak across department stores. So again, Macy's, Nordstrom. Online electronics remains very strong. We thought that this was going to be initial uptick that was kind of going to fade, and it certainly faded a little bit in the last few weeks, but remains very, very strong. So this is where, AMD, Intel, NVIDIA are really seeing gains as a result, because these are the companies that provide the chips and parts that go into a lot of the online electronics, people buying webcams, people buying whatever setups they need at home to work from home, to stream at home, and do those things. So that data set remains very strong. Grocery also actually picking up a little in the last few weeks. I think this really comes down to the fact that people are getting used to being at home, cooking instead of going out to restaurants. So I think grocery stocks are going to continue to be strong. Walmart, Amazon, Kroger, these are the names that you might want to focus on within the grocery space. And then total online retail. This is an interesting one because, the last few weeks when we were looking at this, it was in the strong 30s, low 40s, but it's really started to pick up in the last few weeks, total online retail. So this is telling me that consumers are still trying to spend online on different things. So there are some names of electronic retailers that have a strong online presence. These are ones that are benefiting from it. But overall, spend has started to stabilize. We were in the 30–40% range in terms of total spend decline, but that number has started to stabilize into the mid-20s right now in terms of decline. So it seems like consumer spending at this point is stabilizing, and hopefully in the next few weeks we might see this start to improve, which means that we can start, I think, looking at some bullish names here in this particular space. So contrast that with all of the economic data that we're currently looking at. We've seen the strong rally in the S&P 500. I want to point out that this is mostly driven by fairly a small number of stocks, mostly technology names that have driven this. And that's why we see such a large disparity right now between SPY and QQQ, or SPY and NDX. SPY up 0.5% yesterday, NDX up almost 2%, because it's driven by that technology heavy names. But if you look at economic impact, so Chinese GDP just came out negative 6.8%. This is the first time since 1992 they've even had a even close to negative number. They've never had a number even below 5%, even during the 2008 financial crisis, during the dot-com decline, none of that. So we've had a 6.8% decline in GDP. Granted, this is expected to bounce back fairly quickly. However, keep in mind that this is the second largest economy in the world, and we've seen a significant decline. I don't think that's reflected in the current prices that we're seeing in the equity markets. Jobless claims, again, continue to grow. We have roughly about 22 million people who have submitted for jobless claims or claimed unemployment in the last few weeks. And we have the PPP loan, which is the small business loan that Congress passed a few weeks ago, giving about $350 billion to small businesses to pay for payroll so that they can keep operating. That has now run out of money, and the estimates now are that they need actually another additional $900 billion. And I think Congress and the government is currently working on trying to put together another package. I don't know if that package will be $900 billion. The market seems to be pricing in a fairly sizable second rescue program here. The question here is the size of it, whether it's going to be somewhere in the 500 million range, 600 million range, or closer to the 900, which is what we estimate businesses are going to need. Because, if you look at some of the data right now, businesses say that if they need to close for a month, they have about a 72% chance that they'll survive to the end of the year. But if this gets extended out to 3 months, that number drops down to only 37% of small businesses say that they can continue to operate till the end of this year. So, there's a lot of leeway between 1 month and 3 months. Right now, we're about one month into the shutdown. We're certainly nowhere near opening up our borders. So, there's a significant decrease in the number of small businesses that say that they can stay open. And small businesses employ almost half of the employees in this entire country. So it's a significant portion of the economy that are employed by small businesses. And that's why the small business rescue loan is so important to keep our economy afloat. The other data set that we now are seeing is the fact that almost 35% of people who are applying for unemployment so far have been rejected. So what that means is that the unemployment rate actually, I think, is going to decrease by a little bit than what we had expected, but the number of people that are leaving the workforce is going to be significantly higher. So, the people who need this, I would say, support the most are, there's a good chunk of them currently that are not actually getting it. And that is potentially another downside risk that we see, is that, right now we're pricing in that these that everyone that's unemployed will get stimulus checks, will get access to the $1,200 stimulus, as well as unemployment, including the $600 bonus for 4 months. But it seems like a very decent chunk of them, almost a third of them, more than a third of them, are not able to actually access these benefits. So that is going to be a concern for consumer spending going forward, because right now a lot of the numbers we are expecting that between the tax refund, between the unemployment, the bonus, and the stimulus checks, that would be enough to keep the economy going. But if a third of people are not receiving these benefits, that is a downside risk that we currently see in the market. So what do we trade in this particular market? We've spoken about a lot of different data points. There's a lot of things to think about, but if we look at the market as a whole, right? We've broken back above 283 or 273 last week, which certainly puts us in a much more of a neutral / mildly bullish stance. The fact that we're now back above 284 is certainly even more bullish. I would argue that actually the fact that we've gotten above 284 puts us in a bit of an extreme overbought condition now, which means that going long in this particular case may not be the best strategy. So we continue to focus on selling premium. So if you're going long, doing that by selling premium as opposed to buying premium, by buying calls, buying call verticals, not the type of strategy to do here. I think you're better off selling put verticals on strong names. Liquidity has continued to improve very, very slowly though. We had 55 names when we started this market outlook session 4 or 5 weeks ago that, that quickly rose to about 120, 130 names, went back down about to the 80 level, and we've been hovering around 170, 180. As of yesterday, it's about 192 liquid symbols. So we certainly have a much larger universe of stocks to trade with options right now, but still roughly half of what we normally would consider the liquid list. Earnings season kicks off this week. For those of you that were able to join us yesterday afternoon, we discussed earnings season in a fair amount of detail. We also showed users how to access our new earnings calendar, which I'll show you here in 1 minute. Earnings season kicks off. One of the things that I have noticed for stocks that have reported earnings is that there was an initial uptick or initial move to the upside, and that has continued to fade in most of the names that have seen either a beat or have seen gains after the earnings announcement. So that is one of the things that I'm currently looking at, is fading the strength in stocks that have actually responded fairly strong to earnings. So selling call credit spreads on those types of names, and then so shorting some of the stocks that have reported earnings and are starting to fade lower, and then going long some of the more quality stocks that are likely going to continue to outperform during this COVID lockdown period. So names like AMD, these are the AMD, NVIDIA, Intel, those are the semiconductor stocks. Amazon, Walmart are really kind of the grocery or online retail stocks. You have your consumer staple stocks like Clorox, Colgate-Palmolive, Procter & Gamble, those Johnson & Johnson, and then some of the pharmaceutical stocks also as well. Eli Lilly, Johnson & Johnson, Gilead, those are some of the names that you want to focus on. I tend to, at this point, prefer to be long a particular sector rather than individual names, because I do think that there are some pretty strong single stock risks that we currently see. So, if you like the healthcare space, going long something like XLV or some of the biotech ETFs. If you like consumer staples, going long XLP instead of the individual names. The retailers, also same thing, using some of the XRT retail ETFs. I would play that. Semiconductor stocks, using the whole sector as opposed to individual names as well. So, if we look at the earnings calendar, and again, you guys can access our earnings calendar at trade.optionsplay.com, which I'll post into the chat window. Procter & Gamble released earnings earlier today. Stock is moving a little higher, but I expect that strength will fade a little bit. It already has faded. Pre-market, it was up to that 122, 123 level. It's faded back to 121. Looks like the markets are fading a little bit as well as we kind of head into the open in a few minutes. We were trading as high as 287, 288. Now we're pulling back to 285. That's the type of market that I'm kind of expecting, is that on any pushes higher, you're going to see strength fade. On any declines, you're going to see strength. You're going to see some buying on downside moves. So that's predominantly what we've basically seen for the last few days, right? Is when you get a gap up, we fade, gap up, we fade, and then every time we fade, the markets continue to rally higher. That's what we're currently seeing. So the question is, how far can this go? And again, 284, I think, is going to be a major level to contend with. Anything above 284, you have all of this accumulation that had happened for months that is looking to try to get out at break even at the very least. And I think many of you are probably buyers of stocks in this particular range between April and November of last year before the breakout. And you have stocks that you're thinking, I'd like to try to get out of some of those perhaps at break even. And the markets are now giving you that opportunity. I think a lot of people are going to take that opportunity. But again, keep in mind that this concentration is now just in very few stocks. If you look at small caps have not rallied at all. Small caps, opening up today at 121, which is still below the highs that it put in the last few days. Same thing in emerging markets. This is the trend that we're currently seeing. So pay attention to the earnings calendar. Very important. The current trend that we have seen is all the banks that have reported, whether it's JPM that actually moved higher on earnings, initial move higher on earnings, but started to fade. Same thing across pretty much all of the banks that have reported, stronger than expected, have started to fade. Bank of America, same thing. So that's the strategy that I'm currently looking at, is selling premium, focusing on the strong names for bullish strategies, fading weak stocks, stocks, especially stocks that have boosted on earnings. I think they're going to start to fade on some of those, especially as we get above that 284 level on the S&P 500. So those are the names that we're currently paying attention to. That's the research that we're currently seeing. Like I said, there is, in my opinion, a huge disconnect in terms of what we currently see with the S&P 500 versus the economic numbers that we're looking at. And you can see it in the spread between SPY versus IWM, or the Russell 2000 index. The concentration right now is just in a very few names that's driving the S&P 500 higher. A lot of the smaller names are being left behind in this particular rally. But as the S&P 500 rallies, you're going to start getting inflows to some of those smaller names as a result of it. But be careful, as this market continues to move above 284, you're going to have a lot of sellers trying to get out of the markets at that point. And I think you're going to really struggle between 284 and that 302. But I do think that there's a possibility now, with all the optimism, that we do get some kind of push into that 294, even perhaps as high as 300. But I think that's really the cap that we see here on the market. So if you're going to go long, sell premium as opposed to buying premium. So with that, I want to thank everyone for taking the time out here this morning. If you have any questions, I'll try to spend a few minutes here answering some questions here. So please type it into the the Q&A window. So please bring up your Q&A window if you have a question here. Good morning. I plan on rolling forward in the money cover calls, but not sure the roll forward strike will result in a new debit. So, I mean, it really just depends on whether you think the stock's going to continue moving higher. If you think it's going to continue moving higher, you should pay that debit. But if you don't think it's going to move higher, then let the stock get called away. Buy another, sell some puts on another stock that you would rather own. What airline do you feel most strongly about? So I've been talking about airlines for a while now. As far as, in terms of balance sheets, in terms of what I think is the strongest, I certainly think Delta is a stronger airline. One, they have a smaller exposure to, they are the largest airline in the world. I think they're more likely to get back on their feet a little quicker. But, right now it's really hard to say. I might actually think that domestic airlines may be ahead of the curve here. So stocks like JetBlue, stocks like Southwest, that don't have a lot of international exposure, I think will likely get back on their feet a little faster. Earnings link, I just posted that into the chat window. Microsoft earnings next week. Would it make sense to buy a put with 3 to 4 weeks duration at the money? So I don't think it makes a lot of sense to buy puts right here with the market strength that you see. I mean, unless you see a strong reason as to why Microsoft should move lower, technology certainly is one of these sectors that are going to be affected by COVID less. And also you were talking about a sector that also, is going to benefit from people shifting from working from home. I think that this, everything with COVID-19 is actually beneficial to Microsoft as opposed to, so I don't necessarily think that it's a good idea to buy puts on Microsoft. That's my personal opinion. What about selling S&P? So I wouldn't sell this particular strength. I wouldn't, I think if you own some stocks in the S&P 500, you might want to start taking some profits as we approach that 284, 300 level. These are the times when you might want to start paring back some gains, putting some of those that cash into some hedges, gold, bonds. Those types of trades is how I think I would position a portfolio. Are you going to exit the GILD trade? I think it is definitely time to exit GILD. Are you suggesting to sell a call spread now? I think that on stocks that report earnings take a pop higher, those are the stocks that I'd be looking to sell call spreads on. I don't necessarily know that I would sell them right now. I would usually wait till earnings, because as we've seen, a lot of stocks that have rallied on earnings have started to fade that strength. So that's the strength that you see on that earnings announcement is the one that is the event that I would use to sell premium on. How should we Coupa? I'm not familiar with that stock, so I'll be perfectly honest, I really don't know. Long calls on Microsoft. So I'm not a big fan of buying calls on Microsoft after it's rallied roughly 30% here, or I'm sorry, 20% here. I think I'm better off selling put options here on Microsoft, or selling put spreads rather, Because again, I don't know that Microsoft is going to see a big decline, but I also don't know that it's going to reach back to its 52-week high at 191. I would say that if it gets back up to that 191 level, I certainly would be a seller there. Would you buy leaps and sell calls against them? So, I mean, unless you think that the markets are going to go substantially higher from here, which, hey, I've been proven wrong, but if you think the market is going to go substantially higher back to that 300, 320, 330 level, then yes, buy some leaps, sell some short-term calls against it. I don't personally think that we're going to get there. I think 302 is really going to be a true cap here on the S&P 500, but again, I could be wrong. Quick profit in GLD. Yes, I definitely think we're going to exit GLD. Any thoughts on home improvement? So home improvement, again, is one of the sectors that have remained very strong, and I think this is a sector that's going to continue to be strong. So I like Home Depot versus Lowe's, in my opinion. As you can see, Home Depot is back near those lows. Lowe's is not quite there yet, so between the two, I definitely prefer Home Depot over Lowe's. It's opening up 207. I would certainly look at selling some put spreads, and as long as Home Depot stays where it is, as we've seen in the credit card data, there hasn't been any real decline in spending on home improvement. So I think these stocks will hold up very well during the coronavirus. How do you play NVIDIA? Buy stock and write cover calls. So I think cover calls certainly is a very good strategy right now on stocks like this. Cover calls and shorting puts are the strategies that I would use. I'm short a May 1 that's approaching in the money. What are the chances of early assignment? John, it really depends on the stock. It's hard to answer that without knowing which stocks you're referring to. If you want to send me an email at info@optionsplay.com, I'm happy to take a look at it. Thanks for the great analysis. What do you think about Amazon, especially at these high levels? So, I'm more inclined to fade this strength. Amazon is one of the few stocks that actually opened lower versus all the other stocks have opened higher. I think that's a sign that, things have gotten a little too heated in the last few days. But, if this declines back to that 2320, 2200, that might be a better time to sell some puts, because I do think that this is a stock like Microsoft, with the cloud play, as well as the strong retail play that they have, the strong retail presence, they're going to do fairly well. So with that, I want to thank everyone for taking the time out here this morning. I really hope that this is useful in helping you set up your day and thinking about what should you pay attention to, how should you go about positioning yourself in this market, and please pay attention to the earnings calendar. There's going to be a lot of opportunities to, as we've seen, when earnings estimates are this dispersed, there are higher chances of the stock making big moves on earnings. So this is really an opportunity to review the webinar we had last night on earnings, making sure that you're using the proper ways to limit your risk when you're trading earnings, the different strategies you can trade earnings, whether you're buying calls or puts, buying a debit spread, or selling a credit spread. Those are all viable strategies right now in this particular environment. So make sure you understand how to use those strategies. Make sure you use the earnings calendar to help you position for the right earnings plays, and focusing more so on the very liquid names on the earnings calendar. As you can see on the earnings calendar, most of these names are not very liquid. So if you're trading earnings on those names, be very, very careful. The ones that are in green, you should have no problems getting in and out. The ones in yellow, you should be okay, but the ones below that, be very, very careful. So again, we'll send out the recording to everyone here in about 30 minutes, and I will see you here next week. Have a good trading day.